Good morning. Why investors should buy before the next Fed pivot. And the most profitable commercial real estate investments are rarely made after the Federal Reserve changes course. They're made before it happens, when uncertainty is high, pricing is soft, and competition is thin. And as capital markets brace for the next Federal Reserve pivot, disciplined investors are quietly positioning themselves ahead of the crowd. History, market structure, and lender behavior all point to the same conclusion. Waiting for rate cuts often means paying more for the same asset. So, what a Fed pivot really means for commercial real estate? Well, a Fed pivot, typically a shift from restrictive to accommodative monetary policy, signals improving liquidity conditions. And in commercial real estate, that shift tends to trigger increased lending activity, more aggressive underwriting, and by aggressive, I mean lenient, but also cap rate compression and rising asset prices. And by the time the pivot is confirmed, pricing is already adjusted. And pricing is going to move before the rates do. And commercial real estate is a forward looking market. Institutional buyers, private equity, and sophisticated owner users price assets based on their expectations and not the headlines. When investors wait for rate cuts to feel safe, they often encounter higher asking prices, reduced seller concessions, but also compressed yields on their investment, and more competitive bidding environments as a result of the rate pivot by the Fed. Buying before the pivot allows investors to lock in basis while pessimism still exists. And lenders typically loosen before the Fed acts. An overlooked advantage of buying early is lender behavior. Commercial lenders typically adjust credit appetite ahead of official rate cuts. And here's some of what we're already seeing: longer interest only periods, higher loan to cost thresholds, and improved DSCR flexibility. And there's been some selective spread tightening as well. But savvy investors structure today with refinance optionality tomorrow, positioning assets to benefit from lower rates without overpaying on entry. So, cash flow first, appreciation second. Waiting for the perfect rate is a retail mindset, and then professional investors will focus on the current in place cash flow, the debt yield, and their exit flexibility, but also market fundamentals. And if a deal cash flows under today's rates, future rate relief becomes an upside, not a requirement to make the deal work. Texas markets are leading the cycle. So markets like Houston, Katy, and Fulshire continue to benefit from job growth and business migration to the area, as well as industrial and medical expansion. But it all comes back to population inflows and resilient tenant demand. And these fundamentals support acquisitions before broader capital re enters the market. The real risk is waiting. And historically, the highest risk period is not during uncertainty, it's during renewed optimism. When rates fall and headlines turn positive, prices are going to reset quickly. And the investors who win in the next cycle are buying now, structuring intelligently, and preparing for optionality, not certainty. So here's the bottom line: the Fed pivot will reward preparation, not hesitation. And investors who acquire quality assets before the pivot capture better basis, stronger terms, and a long-term upside that late cycle buyers will miss. Now, if you want to position your portfolio ahead of the next rate move, now's your window. Please visit HoustonRealEstateBrokerage.com to figure out how to get a hold of me. I'd love to talk about your scenario and help you reason through it. Have a good day.